Good morning, Integrity Investments. We are TBKR Financials, and we're here to talk to you today about 4 companies that you guys are going to potentially invest in. I'm Robert, and these are my partners. This is Bill, Teddy, and Kevin. To start off today, we're going to give you an overview about what we're going to be talking about. We're going to give you a rundown of 4 companies: Visa, MasterCard, State Street Corporation, and then BlackRock. Along with those, we're going to give an overview of the industry that they're involved in. Then at the end, we're going to give a team recommendation about which of these companies is the best one to invest in. Then we're going to open it up for questions and comments. Before we start, I want to put you guys into a scenario. Picture you guys walk into your favorite store, and you guys want to buy something. It's not inexpensive, but it's not really expensive. You guys can definitely afford it. When you guys walk up to the cashier, you guys pull out your wallet. How many of you guys would pay with a credit card or a debit card? By show of hands. That's perfect. First industry we're going to be talking about is the credit card processing and money transferring industry. This industry has 2 main services: the debit card service and the credit card service. Debit card service accounts for 42.2% of the industry, and the credit card services account for 45.4%. Next up are a little bit of financial statistics. In 2013, this industry made $55.7 billion. It had an annual growth from 2008 to 2013 of 2.6%. And in this industry, there's about 2,387 companies. The market share of this industry, the 2 we're going to be focusing on, are on the right side, the blue and the red. The blue is Visa, which holds 11.5% market share, and the red is 7.1%, and that's MasterCard. To start off our presentation today, we're going to be talking about Visa. This is the first company we're going to look at. So Visa is the world's largest electronic payments company. It is present in over 200 countries and territories worldwide. Just a little bit of history. In 1958, Bank of America came out with a Bank of America card. In 1970, the NBI took control of this Bank of America card program. In 1974, Ibanco took control of the International Bank of America card program. In 1975, all of Bank of America card and their licensees formed under Visa, under the name Visa. NBI became Visa USA, and Ibanco became Visa International. In 2008, Visa had the largest IPO ever seen in history. It sold 406 million shares at $44 a share, bringing in revenues of $17.9 billion. This is Charles Schwab, or Charlie. He's 47 years old, and he was brought in to be the CEO on November 1st, 2012. He went to Johns Hopkins University, where he received a Bachelor's of Arts. Then he went on to New York University, where he received his Master's in Business Administration. Before coming to Visa, he was a managing director at One Equity Partners, which was a private investment firm of J.P. Morgan and Chase. Last year, he made around $871,000 in annual salary. However, after bonuses, he made over $24 million. A little bit of industry analysis. As I said, it's the credit card processing and money transferring industry. This industry in 2009 made $47.7 billion. In 2013 made $55.7 billion. The major players in this industry are American Express, KKR & Co., MasterCard, and obviously Visa. The market share of Visa, like I said, was 11.5%. However, they outdo their competitors in total transactions and total cards issued throughout the whole world. The competitive advantages are the payments network, payments platform, the range of payment products and services, and also their brand name. The total assets in 2013 totaled to $36 billion. Financial statistics now. Revenues from 2009 to 2013 raised 71% over that time period. Net income raised 108.3%. However, in 2011, 2012, you see this little drop. That dropped 42.2%, and this was because of a lawsuit brought onto them by card processing fees. Next up is the profit margin. You see here that it also dropped in the same year. This was because of the lawsuit where liabilities doubled and the capital expenditures also raised by 6.5%. However, in 2013, they posted their highest profit margin to date. Next up is the share price. From 2009 to 2012, the share price raised 154.6%. 2009-2010, they saw a 19.5% decrease, however, because of a proposed law to curb debit card fees. However, this was never brought to fruition, so obviously the share price just kept rising. Next up is the PE ratio. The PE ratios are above the standard or the S&P 500 average. This shows that investors are looking for this company to grow and they think it's going to grow, so they're putting their money in it to get a return. Next up is the analyst assessment. First up, we have Wall Street. Wall Street is a recommended buy. They project this company to grow 17.3% in the next year, and they're rating at a 3.8, where a 5 is to buy and a 1 is to sell. Next up, we have Yahoo Finance. Yahoo Finance also said to buy. They gave it a 1.9 rating, where 1 was a very strong buy and 5 was to sell it immediately. They also had a target share price of $157.74. This was a 17.5% increase from the year-end 2013 share price of $222.68. Then you have MarketWatch, which says it's overweight. What overweight means is that it's going to outdo its competitors within the industry. And they think it's going to have a higher return than the other companies within the industry. They have a target share price as well of $256.96, which is a 15.4% increase from year-end of the $222.68. With that, this concludes my presentation on Visa. Now I'm going to hand it over to Kevin to talk to you guys about MasterCard.
Thank you, Rob. Coming out into was MasterCard Incorporated. MasterCard Incorporated is the second largest money processing with debit cards in the world, second only to Visa. A little history on MasterCard. The Interbank Card Association was formed in 1966 by a small group of bankers. In 1968, they changed that name to MasterCard, which then expanded outside the U.S. to countries such as Mexico, Canada, and Western Europe. During the 1980s, they launched Maestro, which was the first online debit program of its kind. It was also the largest at the time. In 2001, they launched MasterCard Advisors, which was the first telecommunications customer service. This was a new innovation. No company ever had this before, especially such a large scale. You're talking about millions of customers worldwide. In 2010, they launched MasterCard Labs. MasterCard Labs is responsible for all the innovations they come up with, such as new security technologies on their cards and better technologies to help them reduce their costs. This is the CEO. His name is Ajay Banga. He was born in 1960 in Pune, India. He graduated with his bachelor's degree in economics from St. Stephen's College, New Delhi. He also graduated with his MBA in economics from Indian Institute of Management. His yearly compensation totals at a little over $11 million, with around $8 million of that being his total salary. The rest is in bonuses and stocks. His past employers include, he was the CEO of Citigroup, as well as the head of the Nestle department in India. A little bit more about the industry analysis. MasterCard is in the same industry as Visa. It's the credit card processing and money transferring industry. The industry profit last year was $5.4 billion. MasterCard holds a 7.1 share in that industry, which is the third highest. Some competitive advantage MasterCard holds. First would have to be the size of its company, the second largest payment processor. Another would be brand recognition. It's known worldwide, and that helps out with customers. Also, it's known for keeping its costs extraordinarily low, which leads to high profit margins. Barriers to entry to this industry are very high. There are a lot of regulations and a lot of rules that go into credit card processing. So it's very hard for a new company to start up and get as high as Visa or MasterCard, and it's even harder for a new company to jump into the business. Financial analysis. The revenue and net income since 2009 to 2013 have been steadily increasing. There have been no major drops. There have been no major spikes. It's just slowly inclining, at a good, solid pace. The one downside of this is that it's increasing along with inflation. It's not really making more money as much as staying solid in the same line. The profit margin is probably one of the more impressive statistics for MasterCard, except for 2011, which was a down year for MasterCard. All the profit margins have been increasing. The share price, again, is one of its most impressive financial statistics. It tripled over the past 5 years, going all the way up to $839.37. What MasterCard did recently over the past couple of months is do a 10-to-1 ratio split, in which they multiplied all their stocks by 10. So basically every stockholder got an increase in stocks. They decreased the price down to $75.37. So you still have the same amount of money in it, you just have more stocks and less money for less share. What this does is decrease the sticker shock of it and influences more people to buy into the stock. It's hard for a customer to sit there and buy into a stock that's $839, but it's much easier to look at it at $75 and go, I would want to buy into that. The PE ratio for MasterCard has been always above the S&P. In 2013, it nearly doubled the S&P. Some people see this as a bad thing. What this does is show that people buy into MasterCard because they believe that it works, and it does work. Analyst assessment. Yahoo Finance gave it a 2 out of 5 on the buy-sell scale, buy being a 1, sell being a 5. They look for their stock price to increase over 11% over the next 3 years. MarketWatch also thought their stock was going to increase. They look for it to increase to 89.4 over the next year. They also said that it was overweight. This means they expect this company to outperform all the other companies in its industry. NASDAQ was the only analyst assessment I saw that gave it a negative rating. They claimed their PE ratio compared to their growth rate was too high. What you want is if you have a PE ratio that's high, your growth rate somewhere to be in the 40 range. This means that your company's growing fast enough or its earnings per share is keeping up with it. Also, their price to sales ratio was 11.32. Realistically, you'd like to have that somewhere in the 3 range. Now let's pass it on to Will to talk about State Street.
How many people have actually heard of State Street Corporation? Anyone besides Alex? Okay, well, State Street is a financial service holding company based out of Boston, Massachusetts, and it focuses on investment servicing and investment management. It's kind of like the back office, so that's not surprising that many of you haven't actually heard of State Street Corporation. Let me do a little bit of history. State Street was actually founded in 1792 in Boston, so it has a lot of history, and it's kind of nice that it's still in Boston to kind of maintain its roots, but it started to develop in the 1900s. In 1924, it got developed in various other markets, and I'm going to talk more recently, but in the 70s was probably the most successful years for State Street. In 77, actually, the bank went from a regional retail bank into a global financial services provider, which is how they operate today. So more recently, in 2003, State Street acquired a large portion of Deutsche Bank in Europe, and this was huge for State Street because they're a very global company, and they have like a lot of influence in many markets. And by acquiring the acquisition of the Deutsche Bank, it allowed them to like broaden their market, and it also kind of asserted their leadership in Europe. So this was huge for State Street. And then in 2008, they made an office in Qatar, which is right next to Dubai in the Middle East, and this also expanded their global market into allowed them to have a completely new range of customers and whatnot. And then in 2013, they were appointed by various companies as the top organization that manages all of their investment funds, which is just a nice milestone. A little bit about the CEO, Joseph Hooley, or Jay Hooley. He's a Boston native, and he received his Bachelor of Science degree at Boston College, and he joined State Street in 1986 and became the CEO in 2011. Between those times, he had various leadership positions. For example, he was the Chief Operating Officer, and he was also the Vice Chairman. And right now, he's pretty much responsible for the asset and trading services worldwide, the corporate technology organization that State Street is involved in, and so forth. But his annual salary is around $1 million, which is pretty nice, and with total compensation of about $15.5 million, which isn't bad at all. Okay. Now I'm going to talk about the industry that State Street's involved in. State Street and many other financial companies like State Street are involved in numerous industries, but the one that State Street has the most influence in is the custody, asset, and security services. This is a huge industry with roughly $27.6 billion in revenue, and State Street is actually the leading company in this industry with 31.5% market share, which is really huge compared to its competitors, and basically they just dominate this market. And some of the competitors are Citigroup, JP Morgan and Chase, and Bank of New York Mellon, which all have pretty nice market shares. The reason that State Street has such a competitive advantage, or such a large market share, is because of their competitive advantage. And like I said a couple times before, they're known for their global but They're also geographically diversified, so they're not particularly dependent on like one market or geography for income. So that's nice. And they have 29. They have major financial centers in over 29 countries. All right, down to the financials. In 2009, it was a rough year for State Street, and that's due to the economic recession, the worldwide economic recession. And as you can see, there's net income was down in the negatives. But in 2010, they had a nice leap, increasing by about 20%. But from 2010 to 2013, as you can see, it's been really steady. There's like no really major decrease or major increase in revenue or net income, which isn't a bad thing, but it's just normal. You know, I mean, it's nothing that makes the company stand out or anything. But all right, the profit margin, the negative 24.4% in 2009, if you remember from the Let's Scrap, explains why it's so low, it's the economic recession. But over the past 5 years, the profit margin increased by 68.5%. Until 2013. So as you can see, from 2010 to 2013, it's increased, and the profit margin is just this percentage of the earnings the company receives. Share price. State Street has had from 2009 to 2012 like an average of $45 a share stock price, and that's good. It's pretty good. And then in 2013, it's up at $73.39, and I think today it was 68.65. But this kind of just represents that how they're like pretty strong and they're healthy and it's consistent, as you can see. So that's pretty good for State Street. PE ratio and S&P 500. The PE ratio of State Street has actually never gone over the S&P 500, and as you can see, compared to the two other companies that have gone today, both of their companies were over. But so as you can see, it's steady, but it's nothing too huge for them. And then analyst assessment. I'm not going to go into too much detail, but from Yahoo Finance, MarketWatch, and Morningstar, the company, it's a solid business, but there's not really too much change that's really going to happen. And basically, all the companies, none of them said to sell or don't buy. Basically, they all said just to hold. And you can see from the numbers. This concludes my presentation on State Street. I'm now going to hand it over to one of my competitors, BlackRock.
Thank you, Bill. So as Bill just said, my company is BlackRock Incorporated. BlackRock is the largest asset manager in the world with over $4 trillion in assets under management. And they're based out of New York City. So just a brief history on BlackRock. 1988, they were founded as BlackRock Management. Within 4 years, though, they changed their name to what they're currently known as BlackRock Incorporated. 1995, they merged with PNC Financial Services, which I'm assuming most of you have heard of, which served to be a long-lasting relationship as PNC still currently owns around 22% of BlackRock shares. 1999, they became public, offering up 14% of their shares. From 2003 to 2013, that was a decade of expansion for BlackRock through acquisitions and mergers. So, in 2003, they acquired HPV Management, which is a hedge funds manager. Just a few years later, they merged with Merrill Lynch Investment Managers. And then in 2013, they acquired Claymore Investments in Credit Suisse's exchange-traded funds business, which not only increased their total assets under management, but also globally expanded the company as well. Brief overview of their CEO. His name is Lawrence Fink. He was actually one of the 8 founding members of BlackRock and has served as CEO since 1988. Aside from CEO, he operates as the chairman of the management committee, chairman of the investment strategies group, and also the BlackRock executive committee. His compensation after salary, stocks, and bonuses is a little over $20 million. And what separates Lawrence Fink within BlackRock is his leadership. Since founding it, he's incorporated this investment platform, which BlackRock prides itself on through diversifying classes, geographies, and investment styles. So as Bill said, many different financial companies specialize in separate financial services. So mine is, its main industry is the portfolio management industry. Last year, this industry had a revenue of $193.5 billion, which was roughly a 17% increase since 2009. BlackRock within this industry has a market share of 3.6%, which may seem low, but given that the top 5 competitors within this industry own over 10% of the market share, 3.6 is somewhat high. Its competitors within this industry are the Vanguard Group, which owns roughly 2.8% market share, State Street Corporation, 2.7%, and Fidelity Investments, around 2.4%. And as I mentioned earlier, one of its competitive advantages is diverse platforms, so not focusing so much on one financial service, but offering a broad range of services such as cash management services, risk management services, and financial advisory services. And then also their desire to grow. As I mentioned in the history, acquiring different companies, merging with different companies, and just globally expanding their company. So as for some financial analysis, this is a graph of the revenue and net income over the past 5 years. Both have consistently grown. Revenue in 2009 was $4.7 billion, but has since increased into 2013, closing at $10.2 billion, which is roughly a 117% increase. As for net income, it had the same increase with a 0.9 to 2.9, which is a 22 or 222% increase. And this is clearly shown in their profit margins as well, steadily increasing from 18.62% to 28.8%, which is clear indication of BlackRock's continuation in trying to cut company costs and increase their payment on their overall company debt. The share price has been somewhat inconsistent over the past 5 years. It's not located on the graph, but from 2008 to 2009, coming out of the recession, it increased by some $100. But from 2009 to 2011, it dropped from 232 to 178 due to the ongoing, European economic crisis. But in 2011 to 2013, it's rebounded with, most significantly noted, a roughly 50% increase just within the past year. As for the PE ratio, BlackRock's been somewhat consistent, minus 2009 with the S&P 500, which basically gives BlackRock stock kind of a steady and stable label to it. And then as for the analyst assessment, most all consistently rated BlackRock stock as a holding stock. So Yahoo Finance, for instance, gave it a 2.5 rating out of 5 being buy, 1 being hold, or 1 being sell, with a 10.9% growth estimate for 2014 and an $18.38 earnings per share estimate. MarketWatch rated BlackRock as overweight, which, as might have been Rob said earlier, indicates that it's supposed to outperform its competitors within the industry, and they gave an average target price of share price of $343.29 by the end of 2014. And out of the 18 analyst reviews, 8 said buy, 10 said hold, so still leaning more towards holding. And then as for Morningstar, the Wall Street recommendations, it was a 6-to-1 hold to buy ratio, so yet again leaning more towards holding, and an 11.1% annual growth rate, along with an 18.74 earnings per share estimate. So all three somewhat consistent in labeling BlackRock as more of a holding stock. So now that completes my analysis on BlackRock Incorporated, and now we're going to go into our team recommendations, starting with the 3 companies we did not recommend and why we did not recommend them, concluding with our final team recommendation. So now I'm going to turn it over to Kevin, who's going to talk about why we did not recommend MasterCard.
There are 3 main reasons we didn't recommend MasterCard. First off was their net income was $2.88 billion lower than Robert's Visa. While MasterCard is able to keep its costs low, they can't match the kind of revenue that Visa pulls in. Secondly, their PE ratio is 30.81. As I said before, with the growth rate they're currently having, that's too high of a number for most people to invest in. Also, they have a market share of 7.1%, which is extremely low in the industry that they have. Considering in the credit card processing industry, most companies actually have a large market share. I'm going to turn it over to Will for his questions.
The reason we decided not to invest or recommend to invest in State Street was because the low growth in revenue and net income. My company barely grew in revenue or net income for like the past 4 years, which is pretty significant. And it's kind of, it hurts the company a little bit. And then also the EPS estimated is only to grow about $5 within the next 5 years, which is also pretty low. State Street's not a bad company at all, but it's not a great company to invest in right now. I'm going to head it over to
And as for BlackRock, as I said earlier, though it owns 4% of its market share, compared to Visa, which roughly holds a little over 11%, it doesn't have the same control within its industry. And also, looking at its past 5-year share price of 11.1%, and then also profit margins only peaking at 28.8%. These figures both are significantly less than that of Visa. So now I'm going to turn it over to Rob, who's going to give our final team recommendation from Visa.
Okay, so Integrity Investments. Visa Inc. is the one that we propose that you guys invest in. First reason for this is the industry. The industry is projected to grow 4.8% over the next 5 years annually. It's supposed to grow revenues up to $70.3 billion. Next up is the revenues and net income. Revenues for Visa have grown 71% since 2009, and they don't look like they're going to stop anytime soon. Net income has grown 108.3%, and that doesn't look like it's going down anytime soon as well. Next up is profit margin. As you can see from this table, no other profit margin really comes close to that of Visa. It might seem a little bit high, but that profit margin shows that investors think that this company is going to grow, and it's going to grow its revenues and net income in the future. Next up is the economy stabilization. Now that we're getting over the financial crisis, consumers are going to start to have more confidence in the spending. As they go to spend more, the shift from paper-based methods, so cash and checks, it's now switching towards electronic payments, so credit cards, debit cards, things of that. So as they do that, Visa is going to benefit tremendously from this. And then lastly is the analyst recommendations. The recommendations for all these guys were buys and holds. However, for Visa, they were primarily buys and very strong buys at that. So when we took that into consideration, we present Integrity Investments with a Visa to invest $1 million in. And with that, we want to open it up to questions or comments if you guys have any. Yes.
So with your presentation with the financials, it's kind of showed like the volatility of the market when it comes to the economic standpoint. Well, investing in a company for 5 years, how do you think that that's something that you can still reason around? Like it's still worth it? You still believe?
I think it is. I mean, these companies are all going to be very subjective to the market, the S&P 500, the Dow Jones. However, now that the market's coming back, it looks like it's on an upslope, so you do have to project it to the future and kind of judge what the market's going to do. But as of right now, it looks very stable, so there's no declines looking like they're coming, so it looks very, very positive from now on.
Also, Visa is a big enough company where it can take, as you can see, it can take a recession like that and still be able to bounce back from it and not go under.
What's the biggest risk attributed with investing in Visa?
The biggest risk with investing in Visa is obviously probably the market. So in 2008, when the economy crashed, obviously everyone who had a stake in that share, or everyone who had a stake in the company, obviously their earnings are going to go down. They're going to be cut in half. Whatever you owned, it's going to cut in half. So that's obviously the biggest risk investing in not only Visa, but also MasterCard and any of these credit card companies, which are volatile to the economy and to booms and busts with it.
Do you guys foresee Visa undergoing the same drastic price increase that MasterCard did over the past 5 years?
In terms of
Share price growth, stock price growth. On a Visa as well?
Well, Visa actually had a higher
In the
share
future.
It's not. I don't foresee it going that much, just because as it comes out of the recession, there's a high growth rate, and now it's starting to stabilize a little bit. So I don't foresee it as going up that much, but I do foresee it, as well as other investors and us as a group, we do foresee it increasing a little bit in the future. Yes. Yes.
Could each of you briefly address global aspirations for your company and global opportunities for your companies? For each of you.
Well, right now, 3/4 of the economy done worldwide is done through cash and checks. One of MasterCard's main missions is to get every kind of processing online. For obvious reasons, that makes us money. So realistically, that's their main push. That's their main vision, is to get more global. It's also very difficult because different banks in different countries all over the world have different regulations, and there's a lot of red tape they need to go through. So it's kind of a slow process for MasterCard, but they're slowly building and they're slowly moving outwards.
So piggybacking on that, Visa's in the same boat. It's really hard to go international because of the regulations of different banks. However, Visa's really making a push. They're in over 200 countries and territories right now. They also hold sponsorships in FIFA World Cup and the Olympics every single year, so they are definitely trying to get their name out there. They are trying to expand globally. They're going to do that through expanding online transactions, methods, and speeding up that process from, say, Europe to America. So that's their goal.
BlackRock is definitely starting to expand globally, more so in the past 5 years. One of the last bullet points I had for my history was their acquisitions of Claymore Investments and Credit Suisse exchange traded funds, which Claymore Investments is based out of Canada and Credit Suisse is based out of Switzerland. So they're looking to expand more so into the Europe and actually also into Asia as well. And within its industry, not only globally, but also in the US, but more so into the wealth management industry. It's kind of focused around asset management, portfolio management, but looking to expand that way as well.
And State Street, it's a very global company, and that's pretty much what it's known for. It's actually like one of the leading global financial companies in the world. And through acquisitions and whatnot, they're always looking to expand into other markets and globally. And like for instance, in 2008, when they set up offices in the Middle East, that expanded them into a whole new market. And that's like it's kind of like what they're all about, is like going global and keep on expanding. It's what they're known for, and I think they're going to try to continue to becoming more influential in the global market.
Thank you.